So imagine having $142.8 billion in the bank.
Yeah, that's a number that's hard to even wrap your head around.
Right, but you still wake up every single morning and walk down the exact same hallway to the kitchen that you did back during the Eisenhower administration.
It's wild. The same house in Omaha he bought in 1958 for, what, $31,500?
Exactly. And today we are taking a deep dive into the mind of the Oracle who did just that. It's really a masterclass in long-term thinking, both in finance and, in life.
Absolutely.
And to do this, we're looking at a great stack of sources. We have this really comprehensive ebook called Mr. Warren Buffett, The Oracle of Omaha, a masterclass in investing and leadership.
Which is fantastic on the historical side.
Yeah, and we're layering that with real-time financial profiles, breaking articles, and market data from Forbes, current as of literally today, May 14th, 2026.
It's a really fascinating cross-section of material because we're looking at almost a century of financial history basically colliding with today's immediate market realities.
Right. So the mission here is to unpack how a kid from Nebraska built this empire, look at the core principles that guided his career, and figure out what his recent retirement at the end of 2025 actually means for the future.
Yeah, there's a lot to get into.
Okay, let's unpack this. Because to understand this blueprint that Wall Street has spent decades trying to replicate, we have to start with how his brain was wired in the first place.
Right, his childhood during the Great Depression.
Yeah. And the sources don't just show, like, a cute kid with a lemonade stand. They show a miniature corporate strategist.
The scale of his operations back then is pretty revealing. He wasn't just trading his time for money.
No, he's buying chewing gum and Coca-Cola in bulk, right, selling it door to door.
Scouring the local country club for used golf balls to clean and resell.
But my absolute favorite detail from the sources is the pinball machine.
Oh yeah, the barber shop.
Right. He takes his paper route money, buys a used pinball machine, and just convinces a local barber to let him install it in the shop so they can split the profits.
And that pinball machine is actually a profound early lesson in asset utilization.
How do you mean?
Well, he realized he didn't need to be in the barbershop turning a wrench or sweeping hair to make money. He deployed an asset, let the asset do the work, and just generated passive income.
Wow.
I mean, he was testing the mechanics of monopolies before he even hit high school.
And his family dynamics seem to be the perfect laboratory for this. His father, Howard, was a stockbroker and later a U.S. congressman.
Right.
And Howard drilled this extreme financial discipline into him, but also this fierce sense of integrity.
Yeah, that analytical framework was crucial, but it was really balanced by the women in his family.
His mother and sister, right.
Exactly. His mother, Layla, provided this deep emotional resilience and empathy. And his older sister, Doris, she sparked his lifelong interest in social activism and philanthropy.
So he gets the tools to ruthlessly analyze a balance sheet, but also the ethical boundaries to, not burn the world down for a quick buck.
Exactly. And by age 13, he's filing his first tax return.
Oh, right. Deducting his bicycle as a business expense for his paper route?
Yeah, which is just brilliant.
But I want to talk about when all of this gets tested. He's 11 years old. He takes $120 of his own savings.
A lot of money back then.
Huge money. And he buys 3 shares of a company called City Service Preferred for $38 a share.
Right.
And almost immediately the market drops. The price plummets to $27.
He's down big.
Yeah, he panics, sweats it out, and the second it creeps back up to $40, he cashes out.
Taking a very tiny, very anxious profit.
Right. And, I look at that 11-year-old buying at 38 and selling at 40, and I immediately think of a middle schooler today trading crypto on their phone.
Oh, absolutely.
Right. Watching a coin go up $2, getting a dopamine hit, and instantly cashing out. So I have to ask, was selling at $40 a stroke of early genius, or just a kid getting lucky and bailing out early?
What's fascinating here is that the trade was actually a disaster. Yeah, it wasn't a triumph at all. It's probably the most agonizing lesson of his young life. Shortly after he sold those shares at $40, City Service Preferred shot up to over $200 a share.
Oh, wow. So he missed out completely.
He left a fortune on the table. And why? Because he let temporary price action dictate his behavior.
He missed the massive upside just because he got scared of that short-term drop.
Exactly. And that singular pain birthed his entire philosophy. He realized then that the stock market isn't really a math test. It's an emotional discipline test.
That makes a lot of sense.
He learned the fundamental difference between the price of an asset which, fluctuates wildly based on human panic, and the intrinsic value of the asset.
Right, which stays pretty stable.
Yeah. If the underlying value is solid, you just have to have the stomach to ignore the volatility.
So he has this brutal realization about patience, but he still needs a system, right? He needs to know how to calculate that underlying value so he can confidently ignore the panic.
Right. The actual math.
And the sources point out this massive academic rejection that ironically gave him that system. He actually gets rejected from Harvard Business School.
Which is, yeah, a rejection that fundamentally altered modern finance.
Because he ends up at Columbia University instead.
Exactly.
And at Columbia, he studies under Benjamin Graham, who is essentially the godfather of value investing.
The author of The Intelligent Investor.
Right. And Graham gives him the spreadsheet version of what he learned from that first childhood stock trade.
Graham taught a purely quantitative approach based on this concept called the margin of safety.
Okay, break that down for us.
So you look at a company's financial statements, its assets, cash flow, debt, and you calculate its intrinsic value, what the company is actually worth on paper.
Okay.
If the intrinsic value is $100 a share, but the market is having a panic attack and pricing the stock at $50, you buy it.
So that $50 gap is the margin of safety.
Exactly. It minimizes your downside risk.
Yeah.
You're buying $1 for 50 cents.
So to put that in everyday terms, it's like finding a reliable used Honda for $2,000. Not because it's a bad car, but because a rumor started that Hondas are suddenly out of style and the dealer just completely panicked.
That's a great way to put it.
Right. You've looked under the hood. You know the math says the engine parts alone are worth $5,000 on the scrap market, so you buy their panic. Even if the car won't start tomorrow, you literally cannot lose money.
That captures the psychology of it perfectly.
Mm-hmm.
You aren't just buying the parts, you're taking advantage of irrational fear.
Right.
But Graham's method was incredibly strict. It was all about the spreadsheets. He didn't really care what the company actually did, as long as it was statistically cheap.
Well, let me push back on that framework a bit, especially since we are sitting here in 2026.
Sure.
If you apply Graham's strict spreadsheet-based value investing model today, you'd be paralyzed.
You wouldn't buy anything.
Exactly. We are looking at a market driven by hypervalued tech stocks, artificial intelligence companies trading at hundreds of times their earnings. Isn't a purely quantitative search for a cheap company just totally outdated now?
Well, Buffett actually realized the limitations of Graham's strict method decades ago. He knew that buying a bad company, just because it was cheap, was a terrible long-term strategy.
He called it the cigar butt approach, right?
Yes. You get one last free puff, but it leaves a terrible taste in your mouth. And that's where his second major influence comes in, a guy named Phil Fischer.
Okay, so Fischer was the qualitative guy.
Exactly. Fischer taught him to look beyond the spreadsheet, to evaluate the quality of the management team, to look for high growth potential.
So Buffett basically took Graham's math, the margin of safety, and smashed it together with Fisher's focus on quality.
He merged them. And that synthesis resulted in his ultimate obsession, the economic moat.
The economic moat.
Yeah. He realized the most valuable companies have a durable competitive advantage that protects them from competitors.
So that could be like a massive brand name or a patent, right?
Or a monopoly-like grip on distribution. A moat allows a company to raise prices without losing customers.
Okay, so we have a guy armed with a devastatingly effective philosophy. The margin of safety combined with the economic moat.
A powerful combo.
Right, but I want to see how this actually played out when real money hit the table. Because theory is cheap.
Oh, absolutely.
In 1956, he starts the Buffett partnership with $105,000 gathered from family and friends.
And he immediately starts outperforming the market.
Right, but here's where it gets really interesting. The pivot that defines his entire career happens in 1965 when he acquires Berkshire Hathaway.
And this is where the popular image of him diverges from reality. Today, Berkshire Hathaway is a $142 billion titan owning Apple, Coca-Cola, Geico.
Oh, your queen.
Right. But in 1965, Berkshire Hathaway was a failing textile mill in New England.
A textile mill getting crushed by cheaper foreign competition. It is the ultimate irony that he built a financial empire on top of a dying shirt factory.
It really is.
He applies his famous contrarian mindset. Be fearful when others are greedy, and greedy when others are fearful. But his other big mantra is, our favorite holding period is forever.
Yes, forever.
So how does a guy who claims to hold forever justify ruthlessly abandoning the core textile business to pivot completely into other investments? Where is the line between having the patience of a value investor and just being stubbornly attached to a bad purchase?
That distinction is the absolute core of his genius. He does not hold bad businesses forever. He holds quality businesses forever.
Ah, okay.
And he relies entirely on rationality and data to tell the difference. He strips away all nostalgia. He looked at the textile operations and just saw structural obsolescence.
So the spreadsheets told him no amount of good management could save the mill.
The economic moat was gone. So instead of pouring good money after bad to try and save the history of the mill, he got pragmatic. He took the cash flows the dying mill was still generating and redirected those funds to buy entirely different businesses,
Specifically insurance companies.
like National Indemnity.
Let's double click on that. Why insurance? You hear insurance and you think it's the most boring industry on the planet.
It is boring, but the mechanics of it are financially beautiful. It all comes down to this concept called float.
Float.
Think about how an insurance policy works. You pay your premium up front, say in January.
Okay.
You might not get into a car accident and file a claim until November. Or maybe you never file a claim. What is the insurance company doing with your cash for those 11 months?
Well, they're just holding it in a giant pool somewhere.
A pool they're allowed to invest. That waiting money is the float. Normally, if an investor wants leverage to buy more stocks, they go to a bank and pay interest. Buffett realized that by acquiring insurance companies, customers would voluntarily hand him billions of dollars to hold.
And as long as he priced the premiums right to cover the eventual payouts, that float acted as a massive 0% interest loan.
Exactly. He was getting free leverage. He used a dying textile mill to buy a machine that printed free capital.
That's incredible. And then he aimed that capital at companies with those impenetrable economic moats.
Yes, but only while staying obsessively within what he called his circle of competence.
Right. Keeping things simple.
If he couldn't understand exactly how a business generated cash, he wouldn't touch it, no matter the hype.
Which actually led to some pretty massive misses.
Oh, definitely.
The sources highlight his recent admission of the $10 per click regret.
The Google story.
Yeah. He saw Geico paying Google $10 every time someone clicked an ad. He literally saw the cash leaving his own company to go to Google.
But he passed on investing in Google early on.
Because early search engines were outside his traditional understanding of brick-and-mortar business.
And it's a testament to his discipline. That discipline means he's going to miss some unicorns. But he accepts that because stepping outside the circle of competence exposes you to ruin.
He prefers the certainty of cash flows he understands over speculative upside.
Exactly.
Which brings us to the ultimate test of a forever strategy. What happens to the empire when the mortal architect finally steps away?
Right, bringing us to today.
May 2026. The monumental news from the sources is that Warren Buffett officially retired as CEO of Berkshire Hathaway at the end of 2025.
He handed the reins to Greg Abel after years of meticulous preparation.
And in his most recent annual letter, he talked about going quiet, signaling a very real passing of the torch.
But his financial footprint is as loud as ever.
Oh, yeah. The Forbes data from today puts his net worth at $142.8 billion. And Berkshire isn't just coasting. The data shows they are profiting significantly from recent Japanese market turbulence.
Because Buffett, well into his 90s, identified value in Japanese trading houses a few years ago and deployed billions.
Still finding margins of safety across the globe, setting up the board perfectly before walking away.
But the most revealing part of his final chapter isn't the trading. It's how he is aggressively dismantling his own fortune.
His philanthropy is completely unprecedented. Back in 2010, he started the Giving Pledge with Bill Gates,
asking billionaires to give away at least half their wealth.
Right, but Buffett pledged to give away 99% of his fortune. And the breaking news we are tracking today is that he is currently stepping up the pace of his disbursements to his children's charitable foundations.
And we should note, his kids are now 72, 70, and 67 years old.
Which is wild. They have been waiting a lifetime to manage that level of capital for their projects.
Yeah.
And I have to challenge this model. Because what does this all mean for the listener? He waited until his kids were literally in their 70s to accelerate this wealth transfer. Is there a danger in stockpiling capital for so long before deploying it for social good?
Fair question.
Wouldn't giving away $10 billion in 1985 have done exponentially more social good than giving away $100 billion today, considering inflation and the immediate problems we've faced over the last 40 years?
This raises an important question, and it's a huge debate among philanthropy scholars. But to understand his logic, you have to look at his faith in the money multiplier.
Okay, the money multiplier.
He applied the exact same logic to charity that he applied to buying stocks. He deeply believed that he was the best allocator of capital in the world.
So he viewed himself as a compounding machine for the charity.
Exactly. He reasoned that if he gave away $1 billion in the 80s, an outside charity might do $1 billion worth of good, or they might mismanage it.
Right.
But if he kept that billion inside the engine of Berkshire Hathaway, compounding at 20% a year for 4 decades, it turns into tens of billions.
Wow.
He viewed his primary job as maximizing the ultimate size of the charitable pie before he died.
So he essentially treated his charitable giving with the exact same emotional discipline and agonizing patience that he learned from that very first $38 stock trade as a kid.
Wait for the maximum possible return, ignore the pressure to act early, and let the math work.
And now, in 2026, the avalanche of that compounded wealth is finally being unleashed.
It is a staggering legacy.
It really is. So let's pull back and recap the journey we've unpacked today for you listening. We started with a boy in Omaha analyzing the profit margins of a used pinball machine.
Right.
We watched him learn a brutal lesson about market panic, discover the margin of safety, and combine it with a search for economic moats.
He ruthlessly abandoned a dying textile mill to capture insurance float,
Creating a zero-interest compounding engine that built a $142 billion holding company. And he did it all while prioritizing integrity and a time horizon that measured success in decades.
And, the true takeaway for anyone listening isn't about memorizing how insurance float works or calculating intrinsic value.
No.
Buffett's ultimate competitive advantage was never just his math skills, it was his emotional discipline. The real lesson to apply today is figuring out your own circle of competence, knowing exactly what you understand and what you don't,
Right.
and having the patience to let your efforts compound over time without getting derailed by short-term noise.
Emotional discipline over market panic.
Mm-hmm.
It sounds so incredibly simple, but it is the hardest thing in the world to actually practice.
Absolutely.
And that leaves me with a final lingering question to ponder as we wrap up. We brought this up earlier, but sitting here in 2026, Buffett's entire philosophy relies on the predictability of human nature, right?
Yes.
You look for the moat, you buy the panic, you wait forever.
Mm-hmm.
But as we look into a future increasingly dominated by agentic AI making autonomous decisions, instantaneous global trading algorithms, decentralized finance, the life cycle of a company is shrinking. The moats are evaporating faster than ever.
It forces us to ask if the era of the patient value investor is coming to an end.
Or, and this is the flip side, in a world where algorithms are trained to react to sentiment in milliseconds, amplifying every tiny ripple of panic into a massive market wave, is that old school emotional discipline about to become the most valuable currency we have left?
That's a great point.
When the whole world is programmed to trade in milliseconds, maybe the person who has the stomach to wait decades is still the one who takes the entire pot. Something to think about the next time you find yourself staring at a screen waiting for a number to go up. Thanks for joining us on the Deep Dive.